All right, so welcome back, everyone. It's time for another deep dive.
Yes, indeed.
And this time we're tackling the economy and investing.
Ah, always a fun topic.
You guys sent over a really interesting mix of stuff. I mean, we have interviews, we have articles.
We've got opinions.
Yeah, and some of it honestly had me kind of worried. Some of it had me excited, and some of it, well,
Left you scratching your head a little.
yeah, scratching my head like, wait, what's going on here?
Yeah.
But that's why we have the amazing expert speaker here to help us, well, untangle it all.
Unpack it all.
Unpack it all, that's a better word. And most importantly, to figure out what it all means for you. What do you need to know? What do you need to do with this information?
Right. Because it's like we have all these pieces of a giant puzzle, right? We've got bonds,
Right.
luxury markets, trade wars, a stock market that just can't seem to make up its mind. Where do we even start?
Well, let's start with something that's always been considered kind of a safe bet, right? Bonds.
Oh, yeah.
So one of our sources, a financial planner named David Sheksi,
Hmm.
he really seems to think that bonds might not be as safe as we all think.
Yeah. He's got some opinions.
Yeah, he does. He actually lays out 5 major risks in this interview.
Mm-hmm.
And I got to say, after reading it, I was kind of second-guessing everything.
Yeah, he makes some very valid points. And honestly, these risks are especially important for anyone who is either thinking about retirement or is already retired and is relying on bonds,
Sure.
for income, because it's not just theoretical. This
Mhm.
stuff can really have a direct impact on how long your savings last,
Exactly.
which is a big deal, obviously.
Huge deal. So, okay, risk number 1.
Me.
He calls it sawtoothing,
Sawtoothing, what is that?
which honestly just sounds kind of painful.
Right.
So what exactly is he talking about here?
Well, think of it this way. When interest rates go up, the value of bonds that already exist,
Okay,
especially those with lower interest rates, they actually go down in value.
so it's like a seesaw.
Kind of. Rates up, bond values down. And over time, this creates this like jagged up and down pattern in the value of your bond, hence the sawtooth.
So it's not that smooth ride that we always think about with bonds.
Yeah, not necessarily. And you know what? This ties directly into a second point, which is about net present value,
Okay, yeah.
or NPV, versus inflation. So imagine, like, you put $100 in a piggy bank today. A year from now, you still have that $100.
Right.
Right? But because of inflation, that $100 might only buy you like $95 worth of stuff. So even if your bond is technically making you money, if that return is lower than inflation, you're actually losing purchasing power over time.
Yeah, it's like you're making money but still ending up kind of worse off.
Exactly. And this can be especially tough on people who are retired and are on a fixed income. Their savings might not last as long as they thought because inflation keeps eating away at,
Yeah.
how much they can actually buy with their money.
Right, that makes total sense.
Yeah.
Okay, what about the risk of credit downgrades?
Mm.
He even mentions that the U.S. had its credit rating downgraded.
Back in 2011. Yeah. And that was, even that small downgrade, it had consequences.
Yeah.
It made it more expensive for the government to borrow money, which like ripples through the economy. And what Sheski is saying is that if the government keeps spending more than it's taking in, we could see further downgrades. And if that happens, U.S. bonds start to look riskier. So investors want higher yields to make up for that risk.
So it's like a domino effect.
Yeah.
One downgrade leads to higher costs, which would hurt the economy,
Right.
and then could lead to even more downgrades.
It's a vicious cycle, and
Yeah.
it's a hard one to break. And honestly, it just highlights why paying attention to these little, seemingly insignificant changes in credit ratings is actually really important.
Oh, yeah.
Because they're not just numbers,
Right.
They actually reflect the real-world economic stability.
Yeah, okay, that's a little scary. Okay, so let's move on to his risk number 4,
Okay.
the supply and demand thing. I know this is like economics 101, but how does that actually play out in the bond market?
All right. Well, think about it like a giant auction. If more people want to sell bonds than buy them, the price is going to go down, right? And that can be a really big problem if you have a lot of investors who all of a sudden get scared and try to sell all their bonds at the same time. Sheski calls this systematic risk, and it can really shake things up.
So like a run on the bank, but with bonds instead of cash?
Exactly. Good analogy. And then finally, we get to the scariest risk of all,
And
default,
yeah.
which is basically when whoever issued the bond, they just can't or won't pay back the principal or the interest.
Right, and he uses the example of like Lehman Brothers.
Oh,
It's
yeah.
companies that were, considered super safe, but then just,
Kind of belly up
Yeah.
during the 2008 crisis.
yeah, during the crisis. So that's a good reminder that even those bonds that we think are safe,
Mm-hmm.
they can still carry risk.
Yeah. You got to do your research. And really, it just underscores how important diversification is, not putting all your eggs in one basket. Right.
And really doing your homework before you invest in any bond.
Okay, so after hearing all of that, what does this mean for, like, the average person who might have bonds in their portfolio? Should they be running for the hills, selling everything?
No, don't panic. Panic is never the answer.
Okay, good.
But I do think it's a really good time to take a close look at your bond holdings and really think about how much risk you're comfortable with.
Okay.
If you're really heavily invested in bonds, especially long-term bonds, you might be more exposed to these risks than you realize.
Right.
So it's kind of a wake-up call. To review your portfolio, maybe rebalance things a bit.
Right.
And don't be afraid to ask questions. A good financial advisor can help you sort all of this out and make sure your investments are aligned with your goals. Knowledge is power, especially with your finances.
It really is. It's such good advice. All right, so let's switch gears a little bit here. Let's talk about something a little more, well, luxurious. So in the middle of all this, economic uncertainty.
We've got one article that says Rolls-Royce just had its third best sales year ever. What is fueling this demand for luxury when, everything else seems kind of shaky?
Yeah, it's really fascinating, isn't it? The interview with Rolls-Royce's CEO, Chris Brownridge, he actually gives us some clues. He talks about how there's been this surge in demand for their bespoke cars, the ones that are custom made
Oh, yeah.
to the buyer's specs. And this tells us a couple of things about the luxury consumer.
Let me guess, they're not really losing sleep over a potential recession.
Nope, they're doing just fine. It seems like economic headwinds don't really affect this part of the market in the same way. They have the money to keep spending on these high-end goods, even when, the rest of the economy is showing signs of weakness.
Right, but it's more than just, having the money, right?
Oh, for sure.
What else is driving this spending?
Well, I think it's this deeper desire for, exclusivity,
Right.
for these personalized experiences. These aren't just buying a car, they're buying a statement piece. It reflects their style, their success. It's about standing out from the crowd.
The experience economy, it strikes again.
Right, even at the highest levels.
And speaking of exclusivity, with all these new crypto millionaires,
Oh, yeah.
do you think the typical Rolls-Royce customer is changing?
It's a great question. And actually, Brownridge addresses this in the interview. He says Rolls-Royce has always been about building relationships with clients who truly get their brand. They're not just going after every new millionaire that pops up.
Right.
They want those discerning individuals who really value the history, the craftsmanship.
Right, so they're sticking to their standards.
Yes.
Right.
But it does raise some interesting questions, doesn't it?
Yeah, it does.
How will all this new crypto wealth impact the whole luxury landscape in the long run? Will it change the demographics of the luxury consumer or even the whole definition of luxury?
It's really interesting to think about. Okay, and speaking of potential shifts in the landscape,
Uh-oh, what's next?
let's talk about I guess the elephant in the room, the new Trump administration and their tariffs.
All right, bring it on.
So this Yahoo Finance article made it really clear there are a lot of unknowns
Oh, yeah.
about how this is all going to play out. There could be legal challenges,
Yeah.
and even the experts, they don't really seem to know what's going to happen.
Right.
The article mentioned this 1977 law.
Oh, the International Emergency Economic Powers Act. Yeah, it basically gives the president a lot of power to impose tariffs if they think there's a threat to the economy.
And they even said, the expert said, that he could actually implement these tariffs
Wow.
in 12 hours.
12 hours, yeah. That's a lot of power in one person's hands, isn't it?
Yeah, a little scary. It definitely raises some questions about those, checks and balances.
Checks and balances. Yeah.
And the fact that they've never actually used this law in this way before, it just adds to the uncertainty.
Right, what's going to happen?
Yeah. So a lot of nervousness from businesses, investors, they're all just like, what's going to happen?
Trying to figure it out.
Okay, so it sounds like we could be in for a period of volatility
Oh, sure.
and, legal battles, probably.
Probably.
So how might all of this affect the luxury market specifically?
Okay, that's interesting.
Especially since you mentioned that Rolls-Royce CEO Brownridge talked about tariffs on luxury cars.
He did. He acknowledged that, any price increase because of tariffs would probably impact demand.
Sure.
But he also said that the impact might not be as bad in the luxury sector because of something called price elasticity.
Okay, so basically, if you can afford a Rolls-Royce,
Yeah,
you're probably not that sensitive to price changes,
not so much.
like the average person.
Right. They're more likely to just kind of absorb the price increase without changing their buying habits too much. Think of it this way. If the price of your everyday coffee went up by $5, you might start making it at home, right? But if you're someone who routinely buys like $100 bottles of wine, that extra $5 for your coffee, it's probably not going to change your habits that much.
Yeah, that makes sense. But it does make you wonder about the broader impact, right?
Oh, absolutely.
I mean, could this spark a trade war?
That's a great question.
And lead to higher prices on, everything?
Yeah, on everything. And how would that affect how much we're all spending, across the board? It's the million-dollar question. Unfortunately, I don't have a crystal ball. But honestly, we can look to the past.
Okay.
There are definitely things we can learn from past trade wars. And if we understand them, that can help us all prepare for the potential impact of these new tariffs, no matter what part of the economy you're in.
Right. So maybe history can be our guide.
Our guide.
As we, navigate this uncertain territory.
Yeah.
But before we get too lost in trade wars, let's turn to something that might be a little brighter.
Yes. Let's get to the good stuff.
The stock market. So even with all the back and forth, the jitters, the up and down.
Yeah, it's been a roller coaster.
Yeah. This guy, Ryan Detrick from the Carson Group.
Okay.
He was surprisingly positive in his interview.
He was.
He was. He brought up this statistic.
Okay.
It was really interesting. Historically, the year after the S&P 500 sees a 20% gain is also positive.
Really?
So maybe a crash isn't inevitable after all.
Well, that's a glimmer of hope, isn't it?
Right.
But like always, we have to look at the whole picture.
Right. And part of that picture is that some analysts are predicting a correction, like in the very near future.
Yeah, you've got to consider that.
And some are even saying that if that 10-year Treasury yield keeps going up, we could see even a deeper correction.
Oh, that's no good.
So how do we make sense of all this? What do we need to be watching? And could a correction actually be like a good thing?
Okay. All right. Well, those are all great questions, and we are going to answer them right after the break.
Yes, we are. Stay with us.
We'll be right back. So you were asking about what to watch for in the market.
Right.
Well, one key thing, like you mentioned, is that 10-year Treasury yield.
Right.
It's right around 4.7% right now.
Good.
But some analysts think it could jump to 5%. Or even higher.
That sounds a little scary.
It does.
Why is that so important, and why is 5% such a big deal?
Well, the 10-year Treasury yield, it's often seen as kind of a benchmark, for interest rates.
Okay.
Across the whole economy.
Right.
And when it goes up, it can be a sign that investors are expecting higher inflation, stronger economic growth, and that could push the Fed to raise interest rates.
And if interest rates go up, it means it's more expensive for companies to borrow money.
Exactly.
So that could slow down the economy.
Right, exactly. And if growth slows down too much, then we could be looking at a recession.
A recession.
And the 5% mark, it's important, psychologically, because we haven't seen rates that high in over a decade.
So it's kind of a mental barrier?
Yeah, as much as an economic one. Like if we break through that level, it could really spook investors and trigger a sell-off.
Oh, okay. I see why people are worried.
Right. But, Detrick was pretty optimistic.
He was.
He even said a correction could be a good thing.
I know. That was interesting.
How does that even work?
Right.
Well, a correction just means the stock market goes down by 10% or more.
Okay.
It sounds bad, but it happens pretty often, actually.
Really? How often?
On average, about every 18 months or so.
Oh, wow. I didn't know that.
Yeah. And what's interesting is that corrections are usually followed by, like, a growth spurt.
Oh. So like a reset button.
Yeah, kind of like that.
So you could buy stocks when they're cheaper and then,
ride the wave back up.
Yes, like a sale on Wall Street.
Exactly. Of course, there's always the risk that it keeps going down.
Right.
But if you're smart and you're thinking long term, a correction can be a great opportunity.
So it's all about managing risk, knowing that these ups and downs, they're just part of it.
That's the game.
Right. That's part of the game.
You got to be in it to win it. And you know what else Detrick talked about? He thinks the Fed might actually cut interest rates later this year.
Oh, wouldn't that be good for the stock market?
It seems like it would, right? I mean, lower interest rates make it cheaper for businesses to borrow,
right,
which boosts the economy.
Yeah.
When the economy grows, company profits go up, and that's good for stock prices.
Right. So everyone wins.
It sounds simple, but he also said that inflation might be stickier than we think.
Oh.
Which could make the Fed less likely to actually cut rates.
Right, that makes sense.
So it's like a balancing act,
Yeah.
They want to control inflation, but they don't want to cause a recession.
That's a tough job.
It really is. So yeah, a lot of uncertainty, lots of potential outcomes, both good and bad.
Like a financial choose-your-own-adventure.
That's a great way to put it. Welcome to the world of investing, right?
It's rarely boring. So with all this in mind, what should people be doing right now?
Yeah.
Should they be buying, selling, hiding their money under the mattress?
You know what? Honestly, best advice. Talk to a financial advisor. They'll help you make a plan that works for you, your goals, and how much risk you're comfortable with.
That makes sense.
Because it's easy to get swept up in all the headlines.
Right.
And make emotional decisions.
Oh, yeah.
So having a solid plan, a trusted advisor, that can keep you on track.
Yeah, for sure. Now, before we move on, I want to go back to something we talked about earlier.
Okay.
That potential trade war with the new tariffs.
Oh, yeah.
We talked about how it could impact the luxury market, the economy.
Mm-hmm.
But what about the stock market? Oh, yeah, good point. We kind of got distracted with all the correction talk.
Lots to cover.
Yeah, and the interest rates.
It's a lot. But yeah, these trade policies, we have to think about the ripple effects.
Right.
Because we live in a global economy, you know? What happens over there affects us over here.
So even if I don't personally buy a lot of, imported stuff,
Yeah.
it could still affect me.
Indirectly, yeah. These tariffs, they can lead to higher prices on everything.
Oh, wow.
Not just the targeted stuff. They can mess up supply chains, create uncertainty for businesses, and that makes investors nervous.
And we know they don't like uncertainty.
Not one bit.
So could that cause the stock market to drop while everyone's trying to figure things out?
It's definitely possible. And the longer it drags on, the more uncertainty there is, and that just weighs on everyone.
Okay, so another good reason to be cautious and diversified.
Diversification is key, always. Now, let's go back to that idea of a correction being a buying opportunity.
Okay.
What should people be looking for if a correction actually happens?
That's a good question.
Well, first of all, you want companies with strong fundamentals.
Okay, what does that mean?
Companies that are making money, have healthy finances, and a competitive edge, in their industry.
So they're not going anywhere.
Right. They're built to last.
Not just a fad.
Exactly. And even those companies, their stock prices could drop during a correction.
Oh, wow.
Just because the whole market is down.
So it really is like a discount.
Yeah. A chance to get some great companies at a lower price.
I like it.
Especially if you're in it for the long haul, right? But the question is, when do you buy?
Right. That's the million-dollar question. I wish I had a crystal ball.
Oh, me too. Unfortunately, there's no magic formula. It's research, it's analysis, and a little bit of gut feeling.
So it's like art and science.
That's a great way to put it. You got to look at the numbers, but also trust your instincts.
Yeah.
Be willing to take a chance, but a calculated chance.
Okay, that makes sense. So what else?
Oh, and don't forget about diversification, especially during a correction.
Don't put all your eggs in one basket.
Exactly. If you spread your investments out,
right,
different asset classes, industries, regions, you're lowering your overall risk.
So if one part of the market tanks, I'm not losing everything.
Exactly. Diversification is powerful. It helps protect your portfolio.
I like it. I like it a lot. So after all of this, what's the one big thing you want listeners to remember?
Well, I think the biggest takeaway is this. Knowledge is power. The more you know about the economy, the markets, the better decisions you'll make.
Okay.
You'll be able to handle uncertainty and reach your goals because it's easy to get overwhelmed.
Oh, yeah.
But if you take the time to learn, make a plan, that can make all the difference.
That's a great point. Investing is a long game. It's a marathon.
A marathon, not a sprint.
Not a sprint. You got to keep your eye on the prize.
Stay focused, be patient.
Exactly. Okay, before we wrap up this episode.
Yes.
So before we wrap up, one thing that really stuck with me while we were getting ready for this whole deep dive, there's just like this feeling of fear and uncertainty out there.
Oh, yeah, for sure.
About the economy, about the markets, like what's going to happen.
It's understandable. We're dealing with some pretty crazy stuff, Interest rates going up, inflation's not going away, all this talk of trade wars. It can be unsettling.
It's a lot.
Yeah.
But I also kind of picked up on like a thread of optimism too.
Okay, yeah.
Especially from that Ryan Dedrick interview.
Right.
Remember he talked about how historically the market usually does pretty well the year after a 20% gain.
Oh, yeah, like it bounces back.
It's like a built-in bounce back.
Yeah, and it's true. History can be a good guide, It reminds us that even when things look bad, there are still opportunities out there. The key is to stay informed, be prepared, and don't let fear get the best of you.
So like cautious optimism.
Cautious optimism, yeah. Don't ignore the risks, but don't freak out either.
Right.
Focus on what you can control, your own plan, your investments, and your goals.
So true. It's so easy to get caught up in, the day-to-day stuff.
Oh, yeah.
But taking a step back, remembering the big picture, that's what helps you stay calm and make good decisions.
Exactly. It's a marathon, not a sprint, remember?
Oh, I love that analogy.
It's all about pacing yourself, being disciplined, and not getting discouraged when there are bumps in the road.
Right. The bumps are inevitable.
They are. So before we sign off, I want to leave you with this thought. Even with all this uncertainty, all these challenges, there are always opportunities out there for people who are ready to take them.
Ooh, I like that. A little mysterious. What kind of opportunities?
Well, like we said, a market correction can be a little scary, but it can also be a great time to buy.
Right.
If you're smart about it.
Right.
Pick up some good companies at a lower price. It's like a sale.
Wall Street sale.
Exactly. And remember how we talked about those changes in the luxury market? Maybe because of all those crypto millionaires?
Right.
That could create some interesting investment opportunities, too.
Yeah, for sure.
So pay attention to those trends, see how consumer behavior is changing. That could give you an edge. The point is, stay informed, be ready to adapt, and always be looking for those opportunities, even when things are uncertain.
That's great advice. So to recap, stay informed, be prepared, don't panic, and always be looking for opportunities.
That's it.
Sounds like a good plan for 2025 and beyond.
And beyond. Go forth and invest wisely, everyone.
All right, and to all our listeners, thanks for joining us for another deep dive.
We hope you learned something.
I hope you enjoyed it, and we'll see you next time.
See you next time.